So last weekend, I was walking in the bookstore and came across an interesting book. And it's called The Man Who Solved the Market. And it was about the most successful hedge fund in the world, started by Jim Simons. So that's why I wanted to make this video, because I'm an investor as well, and I kind of want to know what is the highest return someone has ever gotten in the market. And I know I'm not the highest, and that's fine, because my goal is to make around 30% a year. So I want to share this book with you. I haven't finished it yet. I only skimmed through it. I sped read the book when I was in the bookstore. So I kind of got a couple of data points that I want to share with you in this video. Now, before we start, I just want to celebrate another success story within Investing Accelerator. Tony, he made 98% within 4 months from ABMD. Now, this is actually recommended by one of our members within Investing Accelerator, and Tony actually did his own research and then decided that it's also a good investment. So then he bought it, and in 4 months, he made 98%. So congratulations, Tony. You did a fantastic job, and I look forward to your next investment and your next success story. So let's get started. Now, for those of you who don't know, this is actually what the book cover looks like. And that's actually what caught my eye, the man who solved the market. Because when I first started out, I wanted to solve the market too. I love mathematics, and I was actually in honors math when I was studying in UBC for a year. Yeah. And, Jim Simons launched his quant hedge fund and revolutionized the industry. And obviously, he did this many years, probably before I was born. So let's take a look at his story and what makes him so successful and how successful is he. Now, in this video, I want to cover a couple of questions. What's his return? What is the highest return you can get in terms of a hedge fund? What is the Sharpe ratio? I'll explain what that is as well, if you don't know what that ratio is. What is the key skill set when it comes to working for his fund, if that's ever your interest? And how does it compare with the rest of the market? And what kind of people work for this fund? All right, so if you guys don't know who Jim is, this is what he looks like. He kind of looks familiar to me. I've seen him on TV before, perhaps, but I didn't realize that was Jim Simons that started the most successful hedge fund in the world until 30 minutes ago. So let's jump right in, shall we? So first of all, let's look at his return. So since 1988, his return is 66% a year. So that is amazing. And I know a lot of people will always focus on the return after fees, but I don't think that's really the focus, because what I wanted to know is how much return you can get before fees. Because I manage my own portfolio, and if you're managing your own portfolio, it's the return before fees matters, because you're comparing your strategy, which you don't take a fee for, and someone else's strategy, which you shouldn't include their fee. So here, Jim makes 66% a year. That is pretty amazing. And yeah, that's fantastic. So immediately as an investor, I would compare that against my own return. And right now, my return is somewhere between 40 to 50%. So as of the last time I calculated it, it's around 45% a year. So surprisingly, I'm actually not too far off from the top. Now, obviously, if you have watched my free webinar, you'll know my investing strategy has no machine learning, has no AI in it. It's a long-term investing strategy that uses options. And still, I'm able to achieve 45%, which is not too far off from Jim. And later on, you'll notice he has a team of PhDs, and I'm just this one guy. Now, that's actually quite interesting, because I also know another friend that runs a similar quant fund as well, and he makes around 50% a year. So I would say Jim's return is definitely better than his. Obviously, my friend's fund has only been around for around 5 years or so, and he makes around 50% a year. So, and he hires 2 PhDs. So I think that level of return is achievable, especially if the person has solved the market per se. Okay, so if you are an investor and if you're investing in an ETF fund, you're getting around 7% a year, and it's good to have this number in your head that the absolute maximum that people can achieve long-term before fees is 66%. So if you've seen somebody promising you that they can make you 100% return every single year, you know that's probably a scam, because the best hedge fund in the world managing $110 billion, Jim, is only making 66. Yeah. So if you want to take a look at the data in another way, you can compare that with S&P 500. And here's a very simple chart of the fund medallion with the fee included versus S&P 500. So you'll see that this is actually a log scale, and it both started with $1, and over time S&P 500 grew to $20, and medallion grew to $521. So this is the difference between medallion, Jim's fund, versus S&P 500. And this is actually quite interesting, because if you take a step back, right, and you think about it, is the society equal? And chances are the answer is not. Everyone has their own strengths and weaknesses. Everyone has different opportunities and disadvantage and so on. And this is a perfect example of, if someone is good at a certain thing, in this example is actually building a quant fund, you can actually outperform the market by approximately 25 times. So that was really rough calculation, 25 times. Yeah, that's about right. So 25 times higher than the market return. Now, interestingly enough, when he first started the fund, he was actually not performing better than the market. If you look at this period, for the first, let's say 20 years or so, he wasn't performing better than the market. But recently, he must have improved and improved on his algorithm until he got to a point where he's performing better than the market. Now remember, this is after fees. And the fee for medallion fund is approximately 20%. So if you are looking at the growth before fees, this number will be a lot higher. So they probably surpassed the market way before here. And the fee was too much. That's probably why. So when you think about it, it really breaks your belief on what is possible in the market. And I know, because my goal is to make around 30%, which is supposed to be higher than the S&P 500 return. And here you get Jim making $500 from $1, and S&P 500 only makes 20, which is 20x. So this is 20x, this is 500x. So that is the difference. Okay, so if you like another chart, this is the annual return for Jim, and you'll see that initially he was actually, maybe refining his algorithm or whatnot, and wasn't making that high of a return in 1988. Now afterwards, you'll see that, wow, on a year-to-year basis, he actually makes around 25% plus per year, and some years actually makes around 100%. Now this is actually quite interesting, because a lot of people focus on the fluctuation in the portfolio. And we'll cover that in a bit, because that's what the Sharpe ratio is all about. And just looking at this chart, you can already see the fluctuation is quite big. 1 year I make 25%, another year I make 100. So you can imagine how much the portfolio fluctuates. And just looking at this return for the last 20 plus years or so. So that's actually quite interesting. As an investor, you wouldn't expect your investment to go up like a straight line. And if your investment is going up like a straight line, you're probably leaving some money on the table. So this is what a super duper successful hedge fund looks like, and its annual return. Now, let's talk about the Sharpe ratio. And that's actually quite interesting again, because just a week ago, a subscriber asked me for what my Sharpe ratio is, and I don't have that answer because I don't calculate it. Now, what is Sharpe ratio? Sharpe ratio is the return you get minus risk-free return divided by the standard deviation. Now, if you don't know what that means, it's simply the return divided by how much your portfolio fluctuates. So let's say if you're making 10% and minus risk-free, don't worry too much about risk-free. You're making 10% divided by the fluctuation of your portfolio, which is 10%, then your Sharpe ratio is 1. So ideally, you want a very high return, but a very low fluctuation. And that will give you a very high Sharpe ratio. So that is really the goal. So then the first question you should ask is, well, what is S&P's Sharpe ratio? Now, for the past 25 years, this is a Google search again, the average annual Sharpe ratio for S&P 500 is 1. So that's pretty straightforward. I was actually surprised that it is exactly 1. But if you think about it, S&P 500, it's around 7% a year. Now, we can include risk-free rate if we really want to. You'll take off maybe 2-3% and divide it by the fluctuation. So that means the average fluctuation, or the standard deviation in this case, is around 4 to 7% depending on how you calculate it. For myself, I just assume the risk-free percentage to be 0. Now, interestingly enough, Jim's Sharpe ratio, even though he's making such a high return, it's actually greater than 1. So Jim's Sharpe ratio, based on this news article from Institutional Investor, is around 1.89 to 2.5. So you can see, wow, he's actually performing better than market, getting a higher return with lower fluctuation. Now, it doesn't mean Jim has less fluctuation than the market, because if you look at this, you know the fluctuation is quite a bit. What this means is, if Jim is making around 60% a year, then the fluctuation is, let's say is 2. It's approximately half of that. So the standard deviation is 30%. So if you are making 60% a year, your fluctuation is 30%. So when you think about it, wow, that's actually quite high. And a lot of investors who are not familiar with the markets, who are not familiar with investing in general, will get scared. Because wow, a fluctuation of 30% is really high. But if you look at this graph, right, and I just want to explain to the subscriber who asked me this question, the return fluctuates a lot. And if you try to maintain a very steady increase, kind of like getting dividends where it's very predictable, or you're trying to get like a bond where you get interest payment, very predictable with a very, very low Sharpe ratio, then you're going to cut out all the gains here. Because what you will end up getting in terms of an investing strategy is, if you want predictability, you'll try to draw a line here and you'll always take profit at a certain level. So what that will give you is a very predictable return. For example, if I take profit every time when I hit 25%, then everything above 25% is what I'm leaving on the table. And instead, if you try to maximize the profits for each of your investments, then you will capture these bigger gains, like 1 year you make 100%, another year you make 100%, but your Sharpe ratio will not be as good. And in this case, Jim obviously has a return of 66%, and a Sharpe ratio, let's say, is 2, means a standard deviation of 30%. So it is quite high in terms of standard deviation. That means if you just imagine the average here is around 30 or whatnot, the return can be 60 to 30 or 0. So you can see there is that fluctuation. And when it comes to these portfolios that make a high return, I wouldn't be surprised if the Sharpe ratio is low, lower than what people want it to be, because when you're making like 60%, it is very easy, very, very easy to have a 30% fluctuation. And I gotta say, Jim is doing a pretty good job, so that's fantastic. Now, the next question I had in mind when I was doing research was really, how long was Jim holding onto his trade for? Now, given that he's a mathematician, given that he is, starting a quant fund, I suppose that he wants to take profits really quickly. So a very, very short amount of time, and I was right. The average holding period is 2 days. So that's actually within my expectation, because my friend who also runs a hedge fund, his holding period is a couple of seconds. So he's like scalping the market really quickly, and he has an algorithm to do that for him. So for Jim, the average holding period is 2 days, which I think is actually longer than I thought, given that he's using an algorithm that can make decisions very quickly. Now, this is very interesting because for those of you who want to be a day trader and who wants to make the big buck by being a day trader, this is what you're up against. And later on, we're going to talk about Jim's team. But basically, a lot of quant fund nowadays are just using algorithms to make decisions, and they just take profit like that without emotion, without, analyzing anything subjective. It's all quantitative, and they just make the right decision in the blink of an eye. So are you going to be fast enough? Like if you are just day trading, are you going to be fast enough? I don't know. I tried day trading before, 12 years ago, and it didn't really work out for me. So here you can see that the average holding period is 2 days. And for myself, I'm making 45% a year, and my average holding period is somewhere around one year to 2 years. So you can see the diversity of people's investing approach and still being able to make a high return. Now, I was very curious because when I was reading the book or skimming through the book this weekend, I actually got a glimpse of the kind of people they hire, and I actually found a quote on Wikipedia, so you can trust that source. All of his 200 employees ensconced in a fortress-like building in unfashionable Long Island, New York, a third have PhDs. This is actually what I wanted to emphasize to you. A third have PhDs, not in finance, but in fields like computer science, physics, mathematics, statistics. And Renaissance has been called the best physics mathematics department in the world, and according to Witterall, avoid hiring anyone with the slightest whiff of Wall Street bona fides. So that's actually quite interesting, right? They hire non-financial PhDs because what they want when you're trading in 2 days or whatnot is you're trying to analyze the wave of the market. Because when you're looking at daily or even just 2 days and you're trading the market, a lot of things don't matter. Fundamentals probably doesn't matter. News, maybe it matters, but technical matters a lot. And technical is the study of price, is a study of pattern. And if you have enough PhDs, in this case, it's around 70 PhDs, then you probably, figure out a pattern or two where you can consistently trade, buy, and sell in a blink of an eye. So when you are short-term trading, when you are day trading or swing trading, this is kind of what you're up against. And I realized that kind of early in my life that I can't fight against people with supercomputers because my computer isn't fast enough. And it's really difficult to fight against people with PhDs, and especially a team of PhDs. So that's what you're up against. It's actually quite interesting. And if you have a non-financial PhD, then perhaps you can work for this fund. So to summarize, I think there are 3 key lessons. And the first lesson is really, if you are looking at what is possible to date, and obviously some people will say they make a lot more money, but the ceiling is approximately 60% a year. And that's what Jim's fund is making with artificial intelligence, with algorithm trading, with a team of PhDs. But it is possible, and right now I'm 45% return, so I think I'm pretty close to there, and I'm pretty happy relative to what the hedge funds are making, given that I'm just using an hour a week on investing. Lesson number 2, you don't need to know quant or day trading, and you can still get 30% a year. And I wanted to put this as lesson number 2 because I'm the living proof that you don't need quant or day trading, and I'm still making 30% plus. So that's pretty good. So this gives you hope that even if you are a small retail investor, even if you're just starting out investing and you don't have a financial background, it is possible to get 30%. And you don't need to have a PhD to make 30% a year. I mean, if you have a PhD, perhaps you should aim for 60% a year because that's what Jim can do. And number 3, it is possible to perform better than the market. And I think that is the best lesson and a very important lesson because if you go to, study finance in university, you take a certification in finance or whatnot, they'll always tell you you can't beat the market. You can't beat the market. You can't beat the market, Eric. And that's very interesting because people beat the market all the time. Warren Buffett beats the market. So is Jim, so is George Soros. So it is possible to perform better than the market. And if you want to learn more, then you can pick up this book from the bookstore. I think it was just released this year, if I remember correctly. And it's called The Man Who Solved the Market and How Jim Simons Launched the Quant Revolution. So to wrap up, I just want to congratulate Tony again for making 98% in 4 months from AMBD. So that is fantastic. And congratulations, Tony. I'm very proud of you. And I look forward to your next successful investment in Investing Accelerator. So my name is Eric Seto, and I help people without a financial background to master investing and target 30% a year, using an hour a week through a coaching program called Investing Accelerator. So I'm not a quant guy, I don't day trade, I focus on long-term investing. And if you want to learn more about what I do, you can go to this link called 5minuteinvesting.com/free case study, and you can watch the webinar called How to Get 30% from the Market in 12 Months. So this is quite an informative webinar. It's quite long as well, so make sure you get a notebook, get a cup of coffee, get a pen, and prepare to sit down and take some good notes. And you will find a lot of gold nuggets within it as long as you watch the entire webinar. And once you watch the entire webinar, if you do want to join the full program Investing Accelerator, then you can schedule a call with me and we'll have a 45-minute chat to see if you're a good fit for the program. So that is pretty much it. Thank you for watching. So thank you for watching, and I hope you enjoyed the video. Please help support me by like, subscribe, and you can watch the next recommended video here as well. So I'll see you in the next one.